Most people saw the headline, Trump made over $1 billion in crypto, and the immediate reaction for a lot of people was simple. Maybe crypto really is the future. This video is not about politics, and it's not about whether you like or dislike Trump. It's about something much more important: why insiders making money in a system is not proof that the system works for you. Because when you look closely at how those gains were generated, what you see isn't innovation. You see regulatory access. You see policy timing. You see insider advantage. And that distinction matters enormously, especially for households that cannot afford large losses. By the end of this video, you'll understand why crypto rewards access more than insight, why hard assets behave differently across history, and why communities with less margin for error must think differently about opportunity. This is about mechanisms, not hype. How insiders actually make money. Let's start with what the reporting actually shows. World Liberty Financial was structured so that the majority of net revenues flowed directly to the Trump family. The public-facing governance tokens created the appearance of participation, but not control. This is a familiar structure in modern finance. The public provides liquidity, insiders retain decision power, gains accrue asymmetrically. That alone doesn't make something illegal, but it tells you who a system is designed to benefit. Now add regulatory outcomes. Major crypto-related cases were dropped after significant political donations. That's not market competition. That's regulatory access. This is how money is made at the top, not by predicting prices, but by influencing rules. Retail investors don't have that lever. Why price moves are not opportunity. When a president announces a Bitcoin reserve and prices jump within hours, that looks like opportunity, but structurally, it isn't. Policy announcements move markets before the public can act. By the time most people buy, the move has already happened. This is why late entrants often become exit liquidity. Markets driven by narrative and announcement timing reward, early access, policy proximity, capital scale, they punish, small accounts, emotional decision-making, late reaction. This is not unique to crypto, but crypto amplifies it. Why this hits Black households harder. Now we get to the part that rarely gets discussed honestly. The median Black household has far less financial buffer than the median white household. That means losses matter differently. A $5,000 drawdown is not an inconvenience when your total household wealth is around $44,000. It's a destabilizing event. That changes the math. High volatility, narrative-driven assets are not neutral. They extract more damage from households with less margin for error, and those households are disproportionately targeted by breakthrough opportunity messaging. This isn't accidental, it's structural. Speculation versus preservation. Now let's draw a critical distinction. Speculation is about price movement. Preservation is about purchasing power. Crypto is speculative by design. Its value depends on confidence, narrative, and regulatory tolerance. Gold and silver are different. They are not growth engines. They are insurance mechanisms. They do not require belief. They do not require platforms. They do not require regulatory favor. That's why central banks hold gold, not because it's exciting, but because it survives. History as a filter. Gold has functioned as a store of value across empires, currency resets, wars, inflationary cycles. Crypto does not yet have that history. That doesn't make crypto useless, but it does make it unproven under stress. When systems are stable, many assets appear safe. The test comes when they aren't. History is not nostalgia. It's data across failure modes. What this means practically. This is where we slow down and remove hype. For households already exposed heavily to dollars and wages, preservation matters more than upside narratives. Volatility is a cost, not a feature. Physical, non-digital assets reduce systemic dependency. Gold and silver are not replacements for income or productivity. They are anchors. Crypto, if used at all, should be treated as speculative capital, money you are prepared to lose entirely. Not rent money, not emergency money, not generational money. In conclusion, when billionaires profit from a system, it doesn't mean the system is fair. It means they understand how to extract from it. Your advantage is not speed or access. Your advantage is discipline. History shows that wealth is not built by chasing every new vehicle, but by protecting what you already have. This channel is about understanding those mechanisms calmly and clearly, not selling fear, not selling hype, just explaining how money actually behaves over time.